today's segment, which is hedging risk in futures, give you a taste of the content that goes out to our community members. Here is that link to check it out. But let's dig into what I was talking about for our newsletter this week, Mikey. It pertained to metals last week, but I try to make this so in everything that we put together here from the small exchange for our viewers. It's not like one-off stories of like metals are down, this is how you can buy them, but the stuff that you can take from what's going on now or what happened yesterday or last week and attribute it to any market that's moving, because now metals are the calm market, and stocks and interest rates and some of these other cryptocurrency markets and other asset classes are the ones moving lower, and this is directly attributable to those markets. It's simply hedging risk when you're looking at buying futures, and the question becomes, and maybe you can speak to this, Mikey, when you buy some ETH on a day like today, you've been long and now it's collapsing and it's like, I want to buy more. It's down, 8 to 10%. But what's kind of giving you some hesitation is like, it could move a lot lower. Like it could potentially go to zero. I mean, that enters your brain before you click buy, right?
Absolutely. More so with crypto than with traditional products.
The probability of going to zero is probably higher for crypto than stocks or gold, but it enters for every asset class.
Absolutely, especially if you look at these obscure coins that are kind of fun. There's probably a pretty high chance that many of them are going to zero. But absolutely, and then that also ties into the volatility of the underlying asset as well. I mean, sure, there is always a chance that the product can go to zero. I'm a big fan of tail risk, and Nassim Taleb's philosophy of, anything can happen. The worst case thing can happen. Nothing has probability of zero. But also more importantly, I would say, is the volatility on a day-by-day move. You should know how much the thing is realistically going to move. Yeah, there's a chance it goes to zero always. There's a chance Tyrannosaurus Rex comes into this room always, I guess, very small. But what's more likely is that T-Rex doesn't come in this room, and the volatility of that underlying is within its normal range.
And that's why you buy things when they're moving low. Like that's the whole, like our whole conversation today, and my emotion is behind this, because it's like the more likely thing does tend to happen.
Yes.
And the market, does tend to bounce back when it is selling off heavy. But that probability of it going to zero, that outlier thing is there. And I'm absolutely not going to jump on here and be like, forget about that. Like that's irrational and just totally forget about it. No, it should be in your mind, but let's reduce it in your mind and reduce the risk of it as well. And it starts out with just like reducing the distance between here and zero. Like that risk and that hesitation to click buy is super big when the equity product or the gold product or the crypto product is $200,000, which is a lot of those traditional futures. Now they made micros still well above 10 grand. Get that distance between you and zero down to something that's more manageable. Of course, no one wants to lose 7 grand. Let's face it, gold isn't going to zero between now and the end of the day, or whenever you get out of your, gold scalp, or, the S&P 500 or whatever stock market. The stuff isn't probably going to go to zero today or tomorrow, but getting that value between you and zero down to a more manageable, more comfortable piece is going to really do wonders for you. And that starts with just choosing the right product for you, being product aware, and knowing gold futures. Wow, I don't trade those because those move too much. It's like, no, they move the same as micro gold futures and small metals futures, but they're just too big. And so you can go to that small metals futures that's only 7,000, and then you can put some hedges on top of it. Sell a call spread in GLD, or just sell whatever delta calls in the correlating market there to get that product that now was 7,000 down to something that's, with the hedge, theoretically 5,000. And you also have the premium working. I mean, this stuff all makes sense to you, right? Like I feel bad because whenever people think about like hedging or managing risk, they always think like, oh, that's like a whole class I need to take. And it's like, no, just like make your trade smaller. Like that is managing risk is literally taking the investment size or the trade size and reducing it.
Yeah, it kind of reminds me of in high school we had this PE class where we did trust falls, and we started from the ground and we like fell back into a group, and then eventually we climbed up some distance and then fell from even further distances. And starting from the ground is like starting with small exchange features where you're gonna feel your P&L move. Absolutely, it's a real trade, and things move up and things move down. You can make money, you can lose money, but you're not going to start from the highest rung. You might as well start with a smaller product that you know is going to move a little bit less. You're still going to get the feeling, if it's your first trade, that your P&L is moving and your money is on the line, but you're not frantically staring at each tick thinking, oh my gosh, I made 100, now I'm down 100, now I'm up 200, now I'm down 400. Like it's just not nearly as intense, and it's a great way to get started. And then you add in cost basis reduction strategies like selling covered calls, and you scale it down even further. And you're so spot on, Frank, that hedging sounds like this complicated thing where you have to consult with a financial advisor and be very exact. It doesn't have to be that way either. It's spreading your risk somewhere else.
Absolutely right.
Call or another correlated product. There's so many ways to do it and reduce that volatility.
Yeah, love your net. It's more like stubbing your toe as opposed to breaking your back. Like like just choosing a smaller product. Don't box yourself into like, man, like if I trade, it's gonna have to really be emotional. It's like just make it smaller, man. Like you can get in on the opportunity at smaller pieces. Now there's also, as we're seeing today, great opportunity in the equity market. And I put this together last week, but it's especially relevant here today. Small stocks futures are moving. Equity futures are moving. The volatility is on the rise and the standard deviation ranges are widening out. We see here today, 2 standard deviation range in small stocks. The SM75 futures is $2. That means outside of that range, we're getting there less than 5% of the time. We're out there today. Today's outlier move, we're down almost $3, which is a 99% likelihood there, confidence interval, which means less than 1% of the time we're outside of $3. So we're moving and the opportunity is there. Get in there with the smaller products so that you're not breaking your back on the trades. And also, thankfully, we have just some organic volatility in the market. We've got rate decisions all week here today. I think we've got China and Japan tomorrow night, U.S. rate decision on Wednesday afternoon. Obviously, that's going to really move our markets here. And then I think we have a Bank of England rate decision as well. So a lot of stuff here. Take advantage of it and look at these statistics to get things going. Now, Mikey, I need your input here. It's the last part of today's show. Everybody's favorite segment, Pairs of the Week. I'm going to give you 3 pairs trading ideas. You're going to rank them in terms of how much you like them to how much you dislike them. First one here is SPRI versus GLD. You've got a metals market where silver and platinum underperforming gold holding in the best. So I'm looking at buying a SPRI contract and selling about 10 shares of GLD or just 10 deltas in GLD call options short there. That's the first one on the board. You can see the chart at the lows for small metals versus just gold there. Next up, we have the stock market versus crude oil. And this spread is actually getting more intriguing by the minute here. 2 markets very highly correlated with each other. SM75 is actually 1/5 energy stocks that are very highly correlated with crude oil. The equity market is getting demolished and crude oil is holding in above $70 a barrel. I like 1 SM75 long to 1 short SMO contract, and they're a very nice, easy 1-to-1 ratio. Finally, SFX, the US dollar, on the rise with crude oil, like I say, still hanging through those above $70 a barrel highs. US dollars usually, when they appreciate, crude oil priced in dollar tends to come lower. Both of them sitting near their highs. I don't mind a short SFX, short SMO trade on a 4-to-1 ratio respectively. All right, Mikey, what do you like the most? What do you like the least?
My top pick of these 3 is your middle here, the SM75 versus SMO. This is kind of an unusual one. You allude to the fact that other equity indexes are not as exposed to energy as small stock 75, and I'm framing that as the unique opportunity here. I especially love that it's a 1-to-1 relationship between SM75 and SMO. So I don't have to worry about keeping track of ridiculous conversion rates. And I know that I'm just looking at the difference between the two. It's very quick to compute P&L. And I think that we're in for continued volatility in both products. So I want to take advantage of that spread there. Next, same kind of methodology here is the SPRE and the GLD.
Yeah.
We know that gold makes up about 80% of the small precious metals future. So really, we're just getting exposure to silver and platinum. And I think that gold tends to kind of lead those other two metals. And I want to see the reversion in silver and platinum, some of those other precious metals. And then finally, SFX and SMO, though I also really like your take on dollar and equities as well. So maybe there's an opportunity to dabble in the small US dollar and small stock 75.
Yeah, actually, I don't mind that. So small US dollar, short US dollar, short crude, long small stocks trade is actually nice. Well, I'm going to build it with Pete coming up. Mikey, thanks so much for joining me here on Monday's edition of Small Stakes. Splash in the Futures coming up next. It's going to be rapid fire trades, everybody. Everything's moving. Stick around. Thanks for watching.